Hi, hello, namaste, hearty welcome to yet another I Lead Tax Talks. So, thank you very much for joining us today once again. Hearty welcome to the third episode of Retiring to India Right. So, today's question sounds simple. Almost thank you very much, for all the lovely emails that you send me and also the WhatsApp messages that you send me. Thank you very much. It's your feedback or your appreciation that helps me make videos like this. Sometimes I wonder why I'm doing these videos, but again I look at the views and all in a week or so, and I see the response and the views are all promising. So if you know a fellow Indian who is in a situation like this, kindly share this video with them, because we learned in our childhood days that sharing is caring, right? So just share the video, okay? And in case they have any questions, they can always write to me at asknanda@ileadtax.com. Yeah. So let's get into the video today. So today's question sounds simple. In what order should you touch your retirement money? In what order? Okay. The 401k, the IRA, the Roth, the brokerage, the EPF from your Indian years, the PPF your father told you to open. Yeah. 6 buckets, 2 countries, 2 tax departments. Okay. And here is the claim I'm going to prove to you in the next few minutes, that we will be talking. 2 identical retirees, yeah, same age, same accounts, same balances, same city in India, can pay wildly different lifetime tax. Lakhs different. Not because, one earned more, not because, one had a better CA, than other. Purely because, of the order and the timing of their withdrawals. Getting it? Order and the timing of their withdrawals. So that's something, very, very important. Now the sequence here is the strategy, okay? And that's what we are going to talk in today's video. And at the center of it all is a 2 to 3 year, window that India herself, gives every returning NRI. A window most people waste completely because nobody told them it exists, okay? So that's coming in a few minutes, okay? So stay with me. And standard disclaimer, viewers, friends, clients, this is for education only, okay? So not legal, tax, or any immigration advice. Every tax situation is unique, okay? So based on the visa status, based on the income status, and based on other facts also. So talk to a proper licensed tax professional, before you act on these things, okay? You should either be an enrolled agent or a CPA or a tax attorney, okay? So other than these three, if you are trying to consult anybody, and also even if you are talking to any of these three, make sure that they understand the Indian taxes. Getting it? Because we are talking about India also, make sure that they understand the Indian taxes also, okay? Sure. See, the roadmap. See, episode 1, I think it was done, right? Citizenship versus green card versus surrender. Episode 2 also done. Social Security, Medicare, and the 50% spousal benefit. If you haven't watched these two, pause here and go watch them first. Okay, you will see the link, in the same description or in the same channel itself. Okay, just go to the live tab or iLead Tax Planners playlist. You will be able to see the earlier link. Okay, please do subscribe to my channel. I don't do any marketing content. Okay, I'm really making quality tax content. Okay, I get a lot of appreciation from even my fellow peers, EAs, CPAs, and the chartered accountants in India, lawyers. So please do watch. Okay, they're genuine prerequisites. Okay, before your status and your social security timing both feed directly into today's playbook. So today, episode 3, the money itself. Then episode 4, we will talk about PIFIC, F bar, FATCA. I already did 6 episodes on that separately for PIFIC. It's a compliance layer, and honestly, the scariest episode of all the videos I've done so far is the PIFIC. Okay. Then episode 5, we will talk about Indian property inheritance, RNOR status in India, the treaty and things like that. Then in episode 6, we will talk about the capstone checklist. Okay, all 25 decisions in sequence. So subscribe and press the bell icon now. Okay, so episode 4 is the one nobody should miss. Okay, and before we come to episode 4, if you have mutual funds in India, I definitely encourage you to watch my PIFIC episodes. Okay, 6 episodes I think I have made. After that, everything I've been talking in the Zoom calls or in the emails and then trying to address the clients. Okay, I encourage you to watch that. Okay, so that episode 4 also becomes easy for you. Yeah? In the same playlist, iLead Tax Planners playlist, your channel name is iLead Tax LLC. What you see, the company name here, iLead Tax LLC. In that, you have a playlist, iLead Tax Planners. Okay, so I encourage you to watch that. Now, let's recap, the story so far. Suresh first to dominos because today's math, stands on them. Domino 1, the status decision, which is the episode 1. After everything we walked through in episode 1, the N400 trap, the locker myth, the exit tax test. So Suresh's chosen path is the clean I-407 exit. Now, India is permanently home, right? No covered expatriate status. So his 5 years are clean. He is under the thresholds. And here is a detail, that becomes very important today. Now, choosing the I-407 path and choosing when to execute are completely two different decisions. Ready? Choosing the I-407 path and choosing when to execute, it are two completely different decisions. So hold that thought. It's going to matter enormously, by the time we come to the other slides. Then domino 2, the social security timeline. Suresh is delaying his benefit toward 67 to 70, and in episode 2 I told you that's not just about growing the check 8% a year. It is also about what it does to his tax return in his early 60s. It keeps his US brackets empty. Yeah, empty brackets are not a gap, they are an asset. So today you will see why. So these two moves build the runway. So today we land the plane. Yeah. Now, see, every returning retiree asks me these 4 questions whenever I get to speak to them or all the Zoom consultations that they take. These are the 4 questions I get to hear from most of my clients. 1, when can I touch my 401k and IRA, and what does each withdrawal actually cost me? 2, in what order should I drain the accounts? Taxable first, traditional first, Roth first, or does it even matter? And the answer is, oh, it does matters. 3, the cross-border one. Cross-border one. Which country taxes my 401k? I'm living in Bengaluru. India, America, or both? America because the money is coming from America. India because now I'm living in India. And then fourth, and the mirror question, okay? My Indian EPF, my PPF, the accounts India calls tax free. How does IRS treat those? Yeah. So all 4 answers, hinge on that 2 to 3 year window that I mentioned. And most NRIs, they waste it. After today, I think, they won't. So think, which bucket is biggest for you. Pause for a moment. Look at these 4 questions. Think which bucket is big for you? 401k, Roth, your stocks, your brokerage accounts, or your Indian investments? Yeah, send me an email if you're interested to get more information on your query, and I'll be happy to help you. My email address is asknanda@elitetax.com. Now, let's open Suresh and Lakshmi's actual buckets. Bucket 1, US tax deferred, right? The 401k plus a rollover IRA, roughly $800,000. The workhorse, of the plan. And remember, what tax deferred means. Every single dollar, that comes out is ordinary income to the IRS. Remember that. Every single dollar that comes out is ordinary income to the IRS. Not capital gains, but ordinary income. The tax was just deferred, postponed. It was not forgiven. Clear on the 401k plus rollover IRA? Next, bucket 2, the US tax free. A Roth IRA, about 60,000. Small but precious. A qualified withdrawals, zero US tax. And no lifetime required distributions, for the owner, ever. Then bucket 3, US taxable. A brokerage account around 150,000 plus the California home, roughly 1.2 million, which they plan to sell before the move. Now, see, the home sale has its own cross-border rules, capital gains exclusion, timing versus residency. We'll cover that, properly in the episode 5 when we talk about the property. Today, just know the proceeds, land in the taxable bucket, the sale of home and things like that. Then bucket 4, India, about 5 crore rupees, in the Indian mutual funds and fixed deposits. And those mutual funds are carrying a dark secret called PFIC that I will again talk, in episode 4. Plus, Suresh's old EPF from his Indian IT years before America, still quietly, earning interest. So, 6 buckets, 2 tax systems, 1 correct sequence, and draining them in the wrong order is the single most expensive unforced error we see in our practice. Okay, not exotic mistakes, just wrong order. Now, the 3 US clocks. Okay, see, before strategy, 3 American clocks that tick on this money, whether you like it or not. Clock 1, age 59 and a half. The gate that opens. Okay, touch tax deferred money before 59 and a half, and you generally pay a 10% penalty on top of the tax. Now, Suresh retires at 42. His gate is already open, so no penalty. Now, my younger viewers, okay, the 40-year-olds, planning an early return to India, exceptions exist, okay. The rule of 55 for 401ks, okay. The SEPP arrangement under 72T, they are real, they work, but they are precision instruments, okay. So design them with a professional, don't copy them, from ChatGPT or Ask Gemini or Reddit, okay. Then clock 2, RMDs, okay, required minimum distribution, the gate that forces you, the age when the IRS says enough differing, both ho gaya abhi, start withdrawing and start paying tax. And listen carefully, because this changed, recently, and half the internet, still has it wrong, okay. Born 1951 to 59, your RMD age is 73. Born 1960 or later, it is 75. Now, Suresh was born in 1966, so his clock starts at 75. Is that clear? And missing an RMD, the penalty is 25% of the amount you should have taken. 25% of the amount you should have taken. Reducible to 10% if you could, if you correct it, quickly. But still, it is brutal. Next, clock 3, the Roth. The clock that rewards. Tax-free qualified withdrawals after 15 and 59 and a half plus the 5-year rule. No RMDs, for the owner ever. It's the last bucket, you touch. Your longevity insurance, and frankly, the best asset to leave to your children. Now, put the three clocks together and see what they create. Between 62 and 75, Suresh has 13 years of choice. Years where he decides how much comes out and when. After 75, the IRS decides for him. The entire playbook lives, inside those 13 years. Write that down. Next. Now, the RNOR Golden Window. I call it the hero slide. Okay. The slide, this episode was built around. This is the slide, the episode was built around. So, India's gift to every returning NRI. RNOR. Okay. RNOR. Resident, but not ordinarily resident. See, when you return to India after years abroad, you do not become fully taxable in India on day one. India's own law gives you a transition status. Resident, but not ordinarily resident. RNOR. Now, who gets it? The rule of thumb is if you were genuinely an NRI, for a sustained period. Broadly, non-resident, in 9 out of the 10 prior years or very limited days in India, across the prior 7 years, you generally get the RNOR treatment for roughly your first 2 to 3 years, tax years back. Okay. Now, Suresh, 20 plus years in California. He qualifies comfortably for the RNOR status. And here is the power. See, while you are RNOR, India does not tax your foreign source income. I repeat, while you are RNOR, India doesn't tax your foreign source income. Your 401k withdrawals, your US dividends, your US capital gains. So during this window, outside India's tax net entirely, only your Indian income is taxed in India. Then the window closes. You become ROR, resident and ordinarily resident. And from that day, India taxes your worldwide income. Every 401k rupee, every US dividend, everything, everywhere. So think of RNOR as a 2 to 3 year corridor, where only one tax office is looking, at your US money instead of two. See, every heavy tax action, the big withdrawals, the Roth conversions should be evaluated, for that corridor. Now, the window opens the day you land, okay, and it closes on a schedule set by your travel history. Okay, it's not a specific date, that we can tell you, and neither is your convenience. Okay, so you cannot extend it because you weren't ready. You cannot pause it for a family function. It just runs. Okay, and wasting the RNOR years is, in my honest professional opinion, the single most expensive mistake in this entire series. I have watched families burn the whole window, settling in and then pay Indian tax on every dollar, that came afterward for the rest of their lives. Let me know if you have heard of, RNOR before this video. Yes or no? Okay. In my experience, fewer than one, in 5 returning NRIs know this window exists before someone tells them. Okay. Tell people, about RNOR. Okay. Next. Now, the timing mismatch. Okay. Then section 89A and all. So I call it as the trap slide. The earlier one was the hero slide. Every hero has a villain. The trap. Now the trap. So the part 3 of our series long trap nobody sees collection. Okay. Fast forward, Suresh RNOR window has closed. He is now ROR. He withdraws $50,000 from his 401k. Watch what happens. America says US source retirement money, so we will tax it. IRS. India says you are resident now, we tax it too. One withdrawal, and both Modi and Mr. Trump are behind you with hands out. But Nanda, the DTA, the treaty, foreign tax credit. Yes, the treaty gives foreign tax credit, but here is what the textbooks or the publications don't tell you. Credits work cleanly only when both countries tax the same income in the same period. Getting it? Credits work cleanly only when both countries tax the same income in the same period. When the timing is mismatched or different, one country taxing on accrual, the other on withdrawal, different tax years. Like in India, it is April to March, right? And in US, it is calendar year, Jan to December. So credits get lost in the gap. And lost credits equal genuine double taxation, the same rupee bitten twice. I have cleaned up, exactly this mess more times, than I can count. And India's old rules, make it worse. India historically taxed foreign retirement accounts on accrual, meaning India wanted tax on your 401k growth before you withdraw a single rupee. Tax on money still locked inside an American account. Imagine that cash flow nightmare. Just like, PIFIC. Just like PIFIC, in PIFIC taxation in the US, India wanted to tax, your 401k growth in India while the money is still in the America. Then the rescue, Section 89A of the Finance Act 2021, India now lets residents elect to defer Indian tax on notified foreign retirement accounts like the US, UK, Canada are notified until actual withdrawal. Both countries now tax in the same period. The foreign tax credits line up, the double bite disappears. Now, the mechanics. See, the election is made on Form 10EE, okay, filed before your Indian return due date. You miss the form, you lose the alignment, okay. And here's the question I genuinely want to ask in this episode. Does your CA in India know Form 10EE exists? If ever you got in a call with the person, did he ever tell you that there's a form called Form 10EE? I'm not being unkind to my Indian colleagues. There's a there's a special provision, okay, but your retirement account timing depends on it, okay. So definitely ask the question, and I always encourage my clients to understand that tax planning and tax filing are two different things. Tax filing is examination, but tax planning is the preparation. You will do well in the examination only when you do proper preparation. The trap is not the tax, the trap is the timing. The calendar is a tax planning instrument. Next, the bridge years. Let's assemble, the actual playbook. Suresh bridge years, okay, 62 to 67. Retirement on one side, social security on the other. 4 moves, okay, in order. Now, move 1, live on the taxable first, okay. The brokerage, the home sale proceeds. Why? Capital gain rates, high cost basis, low tax drag. This means this money is the cheapest to spend. And while you spend it, the deferred accounts, keep compounding untouched. Getting it? The first move. Then move 2. Fill the low brackets with traditional 401k and Roth and traditional IRA withdrawals. Okay, follow the logic, not Roth. Low brackets with traditional 401k and traditional IRA withdrawals. So between 62 and 67, Suresh has no salary. and no social security yet. Okay, so his taxable income in US is usually low. His brackets are sitting empty, and empty brackets are an asset, and they expire every December 31st. So each bridge year, he withdraws enough 401k money to fill the low brackets. Money coming out at 10-12%, money that would otherwise, collide with Social Security plus RMDs later, and then get taxed at 22% or higher. Okay, same dollars, half the tax, only the calendar changed. Now, the nonce I flagged earlier, and please hear this carefully. This bracket fill play works at US graduated rates, okay? While you are still a US tax filer. Once you have fully exited into non-resident alien status, retirement distributions generally face the flat 30%, regime instead. And we will see that, on slide 12 or so. Which means the order of operations includes your exit itself. For many families, the right sequence is heavy withdrawal and conversion years first as a US filer, and the I-407 executed at the correct point in the sequence, okay, not on day one. This is exactly the kind of sequencing we model client by client. The principle for you to remember is your exit date is a tax lever, not just an immigration formality. It is a tax lever. Okay, now move 3. Time it with RNOR. With RNOR. And here is the beautiful overlap, I can say. The sentence this whole episode exists for. Suresh low bracket bridge years and his RNOR years are the same years. Okay? I repeat, Suresh low bracket bridge years and his RNOR years are the same years. America is taxing those withdrawals gently. India is not taxing them at all. The cheapest withdrawal dollars of his entire life. That overlap is the whole strategy. Then move 4. Roth last. Okay. No RMDs, tax free growth, longevity insurance, inheritance bucket. It goes, untouched until everything else is spent or passes to the children hole. And remember, episode 2's role in all this, okay, delaying the social security to 67 to 70 years doesn't just grow the benefit 8% a year. It's what keeps those bridge brackets empty for the cheap withdrawals, okay? So the two playbooks actually are one playbook. Now, sorry, the Roth conversion play. Now the advanced move, for the same window, the Roth conversion. A conversion moves money from the traditional IRA into the Roth IRA, right? As most of you know. So you pay US ordinary income tax on the converted amount now. And in exchange, that money grows and withdraws tax free forever. Get it? Traditional to Roth conversion. So you are not avoiding the tax, you are choosing to pay it in the cheapest possible year. Now, why the bridge years? Same bracket logic, okay? Converting at 10, 12, 22%, during empty bracket years beats withdrawing at higher stacked rates, okay? After Social Security and RMDs, pile up at 75. Now, why does RNOR make it golden? Because a conversion creates taxable income without putting cash in your hand. The money moves from one account to another. Convert, while RNOR and India has no claim on that conversion income. Convert as ROR and you may owe Indian tax on income. Indian tax on income you never actually received in hand. So cash out of pocket for money still sitting in an account, that is the definition, of poor timing. Now, two cautions, before anyone runs to their custodian. One, convert in measured annual slices, okay, size to your bracket, never the whole account at once. Whenever clients plan for withdrawal, they see the entire money in the 401k, as if they are withdrawing it only that particular year. That's not how it works, right? Convert it into measured annual slices, how much you want to withdraw each year, then size your bucket, but never the whole account at once, unless you have a major emergency. Yeah, a giant conversion spikes you into high brackets and then defeats the entire purpose. That's the first one. Okay. Two, a conversion cannot be undone. Recharacterization is gone. Okay, dead. The law killed it. Model first, convert second. And for my younger viewers, each conversion also carries its own 5-year clock for penalty free access. One more reason, to start early in the window. So, this is precision work. It's also dollar for dollar, some of the highest value work we do, for the returning families. Next. The next one, the EPF and PPF. I call it the mirror image. Okay. We have talked about, America accounts landing in India. Now, what about the Indian accounts held by someone America still considers a taxpayer? Here, everything runs in reverse. India says tax free, but America disagrees. Right? EPF, PPF, and all. Let's talk about EPF first. Okay. India's rule, it is tax free after 5 years of continuous service. Though not interest credited, after your employment ends is taxable in India, a detail many miss. But America's view, while Suresh is a US tax resident, the IRS does not treat EPF as a qualified retirement plan. Sir, what is this? That's how it is. The IRS does not treat EPF as a qualified retirement plan. There is no deferral. The annual interest is generally reportable as income each year, even though Suresh never touched it, even though India calls it exempt. And the account belongs on F bar and Form 8938 every single year. Now, PPF, same story. Sharper edge. India's, most beloved tax shelter, I would say. The famous EEE, right? Exempt, exempt, exempt. But that exemption does not travel across the ocean. For a US tax resident, PPF interest is generally taxable annually by the IRS. Okay. And you need to file your F bar, Form 8938, FATCA, and all also every year. And let me say, something with respect. But honestly, this is one of the most common, cleanup items, in our entire practice. 15, 20 years of PPF and EPF interest never reported. Not because, people were hiding it, but because their US CPA never asked about India and their Indian CA never thought about America. The account fell in the gap between two professionals. If that might be you, the next episode 4 covers the IRS approved cleanup paths in detail. Okay, so don't worry, follow my channel and you can do more research on that. Okay, don't panic, but don't ignore it either. Okay, and once more, the series theme, status decides everything. A US citizen in Bengaluru reports EPF and PPF interest to the IRS for life. A clean I-47 exit ends it going forward. Your episode 1 choice follows every account you own. So if you have still not watched episode 1, I encourage you, to go back, watch the series. Okay, and most of you, are all from the IT industry and all. the different AI tools and all. Try to get a. I think YouTube also gives you an AI summary. If you can, if you feel the entire video is all boring, that this and all, just try to get the summary at least, summary of the video at least. Okay, and if you feel it makes sense to you, watch the entire video. If you are holding a PPF account and hearing this US tax treatment for the very first time, I want you to pay attention because the tax will be huge. Okay? Now, what actually gets deducted from your check? Let's get practical. Okay. When the 401k money actually moves, what gets deducted? Three columns, three statuses, and by now you can predict the theme also. Column 1, US citizen living in India. The custodian withholds like a normal US retiree. You settle the actual tax on your annual form 1040 at graduated rates. Okay, predictable. Boring, but boring is good in taxes. Okay, see, if your tax accountant is asking you too many questions, don't feel offended. Don't feel offended. Okay, he has to ask you questions. A local CPA must be handling, like some 500 or max, 1000 clients a year. So he might be talking to a lot of people, and sometimes, he may miss certain things. So it is for your own good to repeat that. Just give a recap. And if the person is well prepared, great. Like we here, we record the meetings, we get the meeting notes, and also that it's easy for us, to go back. It's easy for client to go back and check that. It's easy for us also to go back, and review what we said. Hmm? So don't feel, bored or annoyed when your accountant is asking more questions. If he's asking more questions, it means he is interested in you. Or else it will be like, okay, 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 right? Okay, okay is not okay. Next, column 2. After the I-407, as a non-resident alien, default withholding on retirement distributions. Okay, 30% under the non-resident alien rules. Now, the India-US tax treaty has provisions for pensions, but the treaty positions on periodic pensions versus lump sums are genuinely technical. And here's the practical reality: some custodians apply 30% regardless and let you reconcile through Form 1040 NR at the end. The tool that starts the conversation is Form W8 Ben, filed with your custodian. But go in, with a licensed tax expert guidance so that you get the numbers right and you have realistic expectations. Next, column 3. The covered expatriate from episode 1. If you left as a covered expatriate, your IRAs were already deemed, distributed at exit, taxed as if fully withdrawn on the way out. And eligible deferred compensation like the 401k faces a locked 30% withholding, on every distribution. No treaty override, none. One more reason, as if we needed one, that the episode 1 exit must be executed clean. That's why I'm repeating it again and again, to plan your exit properly. And the practical rule at the bottom of this slide may save someone watching a very bad month. Okay. Talk to your custodian before the move. Some US brokerages restrict or even freeze accounts the day an Indian address goes on file. Some are fine. You want your custodian's policy in writing. So before you change your address, not after your login stops working from Bengaluru or Hyderabad. Now, the master timeline. Let's put 15 years on one slide. Suresh's money. Okay. age 60 to 75. This is the screenshot slide of the episode. Pause here and save it. Take a screenshot if need be. Now, age 60 to 62, now before the move, buy the Indian health insurance. I think I told you this even in episode 2. Model the full withdrawal plan. Get custodian policies in writing and plan the episode 1 status execution cleanly and at the right point in the sequence. That's the first one, right? Next, age 62, landing in Bengaluru or Hyderabad. The RNOR window opens. Live on taxable money. Begin the bracket managed 401k withdrawals and the measured Roth conversions. Then, age 62 to 65, the overlap years. RNOR plus empty brackets. The cheapest withdrawal dollars of his entire life, and the Form 10EE election filed if differing under 89A. Next, age 65 to 67. Go slow, okay? Go slow. RNOR typically ends, but ROR begins. The 89A election now governs the 401k timing, and India side reporting begins in full. Schedule FA, foreign asset disclosure, which flows straight into the episode 4, which we will talk next. Next, age 67 to 70, Social Security begins. The episode 2 decision paying off, and the 401k withdrawals throttle down as the benefit, fills the brackets. Then, age 75, RMDs begin, and here is the payoff of the whole plan. If the bridge years were used well, the deferred account is already trimmed. The RMDs are small and painless, and that was the plan, all along. The forced withdrawals arrive, and there's barely anything, left to force. Now, see, every age that on this line was decided years earlier, right? Retirement income is not a decision you make at 75. It's a sequence you set in motion at 60. The calendar is the instrument, but sequence is the strategy. Now, 4 questions to take from today. Probably you can pause, screenshot, sit with your spouse, watch the numbers. Question 1. What is my exact RNOR window? What is my exact RNOR window? Opening and closing dates based on my actual travel history. Not the rule of thumb. Your passport stamps, your day counts. The window is personal and the plan hangs on it. Question 2. How much should I withdraw or convert each year off the bridge? Sized to the US brackets. There's a right number, for every year. And it changes every year. Question 3. Should I file the Section 89A election? Form 10A. And the honest follow up, is my Indian CA even aware of it? Yeah, just check with him. If he knows it, great. Next, question 4. Has my custodian confirmed in writing what happens to my 401k and IRA with an Indian address on file? Because a frozen account discovered from India is a crisis. The same question, asked from California is a 5-minute phone call. So, your homework, one thing, log into your 401k and IRA accounts and write down 3 numbers. What's my total balance? And in that, how much is traditional, how much is Roth? And that's your bucket inventory. Everything that we did today starts from those 3 numbers. And then you can email me or connect with your CPA or CA with what percentage of your retirement money is in the traditional bucket, 80%, 90%, and that number is exactly why the bridge years matter. Okay, so in episode 4, we'll talk about the compliance trap, PFIC, FBAR, FATCA, your NRE, NROF, CNR accounts. So remember, Suresh 5 crore in the Indian mutual funds. Those funds have a dark secret the IRS calls PFIC, possibly, the harshest tax regime in the entire American code, and it's sitting quietly in lakhs of NRI portfolios right now. I feel very surprised when people don't even know about FBAR and FATCA. But we will also cover the IRS approved cleanup paths if you are already behind. Okay. Now, the scariest and the most valuable episode of the series is PFIC. I encourage you to watch those 6 episodes, at least for knowledge sake, and then guide, the fellow Indians. In fact, I have also written, to the HR heads, the payroll heads, the decision makers in the company, to educate their work staff, their staff or their team on these, tax planning videos. So if you can share this kind of video, with your company HR, and ask them to just share the video, just that playlist, I lead tax planners playlist. I mean, the employees can watch. Many people don't know that the tax system works completely different in the US. In India, if you file one return, that is enough. But in US, it's not like that. You have to include even your wife income. You have to claim your kids. You have to file for state, city, county. Then you have this FBAR, FATCA, PFIC. So inheritance, again, there are different forms, gifts. So I encourage you to, please spread knowledge. As I always keep telling you, 100 clients like you, they create one job for my student in India. Thank you very much for spreading the news about iLead Tax LLC. I also run one of the finest academies in India, iLead Tax Academy, wherein we train people on US taxation, bookkeeping and payroll. And clients like you are a reason for creating employment in India. In a world, where people are losing jobs, thank you for being a reason to create one. Yeah. And if today's sequencing raised questions about your buckets, your RNOR dates, your conversion sizing, your exit timing and all, this is precisely, the modeling work we do. So you can book a personal consultation with me. The Calendly link is in the description. Calendly.com/Nanda Kumar K V /iLead_tax_planners, or visit iLeadTax.com, or write to Ask Nanda at iLeadTax.com, or also you can WhatsApp the numbers that we have given there. So remember what I always say at iLead: plan your dream. Plan your dream. Don't just dream it. ILEAD, it stands for income, liabilities, expenses, assets, dreams. Nanda, I want to do this, I want to do that once I'm in India. I feel so good, I feel so encouraged, motivated. But if you don't plan the dream, somebody is draining your dream without any mistake of yours. Thank you very much for spending this time with me. I'll look forward to see you in the next episode. Please feel free to write to me with any of the tax planning questions that you have, and my team and I will be more than happy to help you. Take care and have a wonderful week ahead. Yeah.